All right, let's hop into the next chapter here. Time frames. You have to understand what time frames that you're using, and but ultimate goal is to understand that which time frames you're gonna like the most, which time frames you're gonna use the most, and that way you're not getting caught up and looking from the 1 minute to 5 minutes to 15 to 30, 1 hour, 4 hour, and then you're going all over the place and you don't know exactly what you're gonna do. So most important thing is to start with the shorter time frames. If you don't like looking at the 1 minute, then look at the 5 minute, 15 minute. The 5 minute chart and the 15-minute chart, that way you're not hopping up and down every 60 seconds on a new candle. So by looking at the 5 minute and 15 minute, you're looking for a shorter term on scalping and for just a little quick turnaround on making small gains and small profits. And so I know I have it set here on saying that scalping volume, looking at the small swinging actions on price jumps and breakouts if using the Bollinger Bands. You don't have to, you don't have to use the Bollinger Bands to look for a breakout. So what I mean by that is that if you're not using any indicators and you want to go straight into naked Forex, like what I'm doing right now, then you can go ahead and just look for that big bearish candle going out down, or the big bull candle, the bullish candle breaking to the upside. And so that's the most important thing. And like I said, if you want to get into swinging, start with a 30-minute chart, work your way to the 1 hour, because the 30-minute chart is just every 30 minutes, and then the 1 hour is every 1 hour. And so with the 30-minute, when you're hopping back from the 30-minute chart to the 1 hour chart, they're very, very similar because they're only 30 minutes apart from the candles. And so not a whole lot of difference, but at least you can catch the trend and see the trend structure. So that's very important to take a look at. And then once you get used to it, then, by swinging based on the 30-minute, usually like if I was going to swing on a 30-minute chart, I would still hop on the 4 hour because I want to see how long I'm going to ride this trend out for the whole session, or maybe for the next 8 to 12 hours. Because on the 4 hour chart, you can ride a trend for 2 sessions in a row. Like that's 16 hours straight. And so that's another thing to take a look at. And that way, when you look at the 30-minute and the 1 hour, you get a bunch of candles. That's the only problem, because every other candle is like a retracement candle. And so I'm repeating a lot of things here, but you don't have to be like, oh, well, if I look at the 4 hour, then the 4 hour is not going to close until, if you're in Central Time and you start in New York at 8 in the morning, you know that the 4 hour candle just started at 8 o'clock and it's not going to close till noon. And restarts the new candle at noon, and then it doesn't close till 4. And so that's why for that whole session of New York, you get 2 4-hour candles, or you can look at 16 30-minute candles, or 8 1-hour candles. And so that's something that you should really take a look and dive into. That way you're not focusing on too many candlesticks, because sometimes candles can be deceiving, especially if there's a pullback or a retracement and you're trying to follow the uptrend or the downtrend. And that's the most important thing, because after this, like I said, after the second hour of each session, then you're looking for a direction. And so the first hour is there's always retracements and there's always high impact news, especially during New York sessions, even for Tokyo and for London. So it's something to remind yourself. I know I'm repeating a lot of things here, but I want to get you guys get the ball rolling. And so this is a part 2 video, because I just realized that I'm on page 17, and the first part of the video, for those of you who are watching it, it's a 43-minute video. So by the time I get done talking about a 135-page book, it's going to be like an 8 to 10 hour video. And so I'm breaking it down, and I didn't realize how long I was talking. And so even though I'm timing myself, it just gets a little bit, I get too outside. So I just want to be, I'm just being honest with you guys, letting you guys know. And you know, with the time frames, like let's talk about the 4-hour daily, weekly, monthly, because you're gonna have to learn how to swing long term. You're gonna have to learn at looking at future price projections and future trends and where things are going for the next day, for the next week, and for maybe for the next 90 days, for the next quarter, or what could possibly happen for the next 2-3 years because we have a new president. And so that's a very important thing to take a look at. I want to stress this because with the daily, weekly, and monthly chart, once you get good at it by swinging long term based on the 4-hour, on the daily, weekly, and monthly, the candlestick structure is a little bit more precise. The trend structure is there, and you don't and you can get to see a clear view of resistance and support. That's the most important thing, because by looking at resistance and support on a daily, weekly, and monthly, then you get a good confirmation, and you get a good indication of okay where prices are headed for long term. And so I don't want to be making this a little I don't want to make anything too confusing for you guys. And so that by looking at higher time frames, that you are looking for longer term trading. You're looking for long term trades, and you're looking like based on the daily, you could swing your trade for the whole week, because every single day you get a new daily candle. On the weekly, you're looking to swing for maybe at least 2-3 months on the weekly, and on the monthly, you're looking to swing for 6 months to a year. And that's just what most top professionals are talking about. But we're not looking to long-term swing for that long because we don't have the capital and the margins to cover that. Especially, even on $1,000 account to go on a weekly and a monthly swing, it gets kind of tough because you're stuck in that one trade for a long period of time, and you're paying a lot of swap fees. That's if you want to pay a lot of swap fees. I don't recommend that. I mean, I would recommend looking at the 4-hour and a daily chart, so you get, and if you want to do a full weekly swing, then yeah, there is no issue on, the full weekly swing. And so let me pause this real quick. All right, let's get back into it. So I want to let you guys know that I'm going to be pausing in and out. And so, like I said, stay home, dad. Still got kids here. And I'm going to try and run through this whole book. And it's around page 17. So I don't want to get you guys confused here. But yeah, back to like the week, to the 4-hour and a daily. You start with that, and then do a full weekly swing on a demo account. Like put all the trades in, all the major pairs, or every single pair if you want to. And that's what I did. Like what I did was I put all major pairs, like AUD, like the Australia to the dollar, New Zealand to the dollar, Euro to the dollar, the pound to the dollar, USD JPY, USD Swiss franc, USD CAD, gold, and the US dollar index if you can do it. If not, that's fine. But those are the 9 pairs that I put into my demo account last year, and I was looking for, okay, let me swing this whole trade. Let me swing these trades for the whole week. Start that on a demo account, and you get to see where this weekly projection is going on the trend. And then, like I said, the 4-hour trend will start the daily trend, and then the daily trend will create the weekly trend. And then the weekly trend will create the monthly trend. And then you start seeing this pattern. And so not every week is a great week to do a full weekly swing and based on daily and 4-hour chart, because like I said, in the summertime, you don't want to be trying to swing trades for that long. And now you can do it. You can swing better and swing more trades during the winter time, but not during the summer. I mean, if you clearly look at swinging right now from last month, because we're in the month of August right now, from July and up until now, really not a whole lot of swinging involved. I mean, everything's just been consolidating up and down, very tight price ranges. And if you look at the daily chart and the weekly chart, you can see that prices are stuck at a certain, the currencies are stuck at a certain price level structure, and the prices are very narrow, and you don't want to be looking at the daily or the weekly or the monthly. And it's okay to look at the daily for the new candle every day, but you have to shoot back down to 4 hour and 1 hour and 30 minutes, 15-minute charts, because you'll end up scalping, and you'll end up scalping more in the summer than in the winter time. Now you can scalp any season, but I'm just talking about the 4 seasons here because I live up north, and you can see price levels aren't really doing anything for the summer. There's really not a trend structure to follow in the summer, and you shouldn't be really basing everything on the daily, weekly, or monthly. And so until the end of this month, for August is over, then you can hop into the fall season and be like, okay, we got September, we got October, November, and we got December. We got the last 4 months, and what's the last 4 months going to do? And so very, very important not to get yourself caught up on that. And then, like I said, once September hits, then we're going to be coming into the fourth quarter anyways. And remember, there's 4 quarters every 90 days. Okay, every 90 days, there's 4 quarters. Every quarter has a pattern. Every 90 days, there's a pattern. I'm not talking about the time frames here because I'm hopping into different subjects, but you gotta look at both ways, not just the charts, but you gotta look at both ways. If something goes up for that long for the whole summer, obviously it's gonna retrace. It's gonna do a massive pullback for the fall. Just if you look at last year, I mean, I'll talk about that in another chapter here, but that's another thing to take a look into. So let's end this time frame here. Indicators. I don't want to dive down too much on indicators because I don't use them anymore. And if you want to, like I said, the only one that I really have is just the 10-day moving average. And the only reason why I still have the 10-day moving average is just looking to see if the candlestick structure is riding below the 10-day, or if the candlestick is riding above the 10-day. Now, I only have it on my phone, but on my computer, I don't have any indicators at all. So it's very different from there. The RSI I don't use anymore. MACD I don't use anymore. Fractals, stochastic, parabolic SAR, Bollinger Bands. I mean, I'm not using any of this. Momentum, no, I'm not using it. And like I say, once you read the book, I mean, right here, I want to reiterate this. Most important indicators are the bottom ones to know overbought and oversold conditions. That was the most important thing, but not anymore. When something is overbought and oversold, it's not, like I said, it's not really precise on getting in on an entry point, because you want to enter at the right time, right? Timing is everything in Forex. If you enter because RSI was oversold or the stochastic was overbought, and all of a sudden stochastic still shooting up on the uptrend, and you're like, man, I don't know why it's still shooting up. Well, you have to look at the candlestick structure. Is it creating that line of resistance? If it's not creating that line of resistance, then you're missing out. Then you're not following the trend structure and the candlestick structure. Then you're losing more money by following a overbought or oversold indicator. Indicators are just based on the volume and calculated math on price. And so I wouldn't stress too much on looking at that, but if you are still using those bottom indicators, you have to understand that even if it's overbought on that time frame, you have to hop to the next higher time frame. If it's overbought on the 1 hour, you should look at the 4 hour. This is just a rule of thumb. If it's overbought on the, I know this says number one, you do not need every indicator to be successful at trading. That is true, but this is my next rule of thumb. You don't, like I said, if it's overbought or oversold on the 1 hour, hop into the 4 hour, because you don't know if it's oversold and it's overbought on the 4-hour. On the higher time frame, it's not overbought or oversold. It's just that most of the indicators are probably just sitting at the bottom or peaking in the middle. And so that's another thing to take a look into. And when prices hit so high, especially when they're going up on a massive uptrend, then you have to look for that next line of price resistance, and you have to, start looking at, okay, how high are you going to shoot this price up? Sometimes you might have to look at the daily chart. Sometimes you might have to look at the weekly chart, especially when they're shooting a currency that high. And so you sometimes that you get caught up on looking at, what's overbought, what's oversold, what indicator is your primary indicator, what indicator is your secondary indicator, and sometimes indicators aren't really helping you out. And so I'm just being honest to you guys to let you guys know that once you get into naked Forex and you don't use indicators anymore, I mean, it's just a lot better on my point of view. And you can see here, if you read this, these were last year's indicators. It can get so confusing when having four indicators on the top. That's why I had 4 indicators on the main window and 4 indicators on the bottom. That was just nuts. And then, and then right here, you need to know what your primary and secondary indicator is at all times. That way you don't get confused on looking at different indicators. Otherwise, you're going to end up losing more money. And we're only on page 20. So this is the indicators that I was using last year. Okay, and that started decreasing and start taking them out individually. So yeah, you can see right here, I had this all typed out. And you can see this is Bitcoin on the 15-minute chart. And so what I want to show you guys that what I outline here is you can see a lot of resistance that created here. On the third resistance, it made this strong bearish movement going down. And then it picked right back up. Anytime it goes down a lot, like it doesn't matter if it's a currency or crypto. When it shoots down, whether it's 50, 60, or even 100 pip drop, it's going to retrace back to where it fell most of the time. So you can see the pullback going back, but it never came back to retest the 8,300 price, and then created another level of resistance here at 82.75. And if you go back to this time frame, or well, you don't have to go back to this time frame, but if you go back to like the 1 hour to 4 hour, because this is this chart was I think 2-3 weeks ago. And then you can see, but if you go back to the Bitcoin time frame, you can see that Bitcoin shot right back down. And I believe Bitcoin is at its lowest price right now, I think. Let me see. Yeah, Bitcoin's at 6,400. So very interesting to, so very interesting to see, how things are changing up, especially in the crypto world. And this is just a quick little snapshot on this. Yep, and I even talked about it, and it failed to break through that resistance price at 8,300, so it fell back down. And like I said, the price of Bitcoin right now is sitting at 6,300. Same thing here on 15-minute chart. I have the horizontal line, and this is just an updated 15-minute chart the next day, and you can see that it's just been consolidating, but it hasn't come to retest higher. And so, but the weekend after, it tested lower, and it broke lower, and it broke the 7,800 price. So this was July 30th, 2018. So you can go back to this. This is pretty recent, and I want to make sure that these charts are all my charts are from this year. So I don't want to be confusing anybody, because you shouldn't be looking at charts 5 years ago or 10 years ago, unless you're really looking for the overall yearly structure on currencies. But that's if you really want to dive into it and look into, okay, where things are being projected. And so the whole goal is just naked Forex now. And you can read all of this if you want to. And like I said, it just gives you, like I said, go naked Forex. The number one thing is you get a clearer view of candlestick structure and price action. That's it. And then you're just following the main window. You're basically just not following I need to look at our side. You don't have the bottom window anymore. So you can be glued on to, where candlesticks are going. And that way you're not like hopping back and forth and be like, oh, well, I need to have stochastic RSI and MACD so I know what's overbought and oversold. You can, if you want to start that out. But those that have the first book and are looking into the second book right now, I mean, you should have some kind of input of where your strategies are going, where your methods of strengths and weaknesses are coming from, and what you really need to work on and what you're lacking on. And that's the most important thing. And so I'm just hopping into everything here as much as I can, because this is a very long video. I mean, like I said, this book is very helpful, and the first 4 chapters that I read out of this book made sense. And so you can, I would suggest reading the first 2 chapters of this book to see if you want to go into naked Forex. You don't have to, but by going naked Forex, I mean, they even talk about they even outline the difference from looking at RSI or the what else? Stochastic or the MACD or other indicators, why it takes forever to make that indicator to let you know to buy or sell, or the timing is off. Most of the time, the timing of indicators is way off. It is. And sometimes it's just not as accurate as what they say it is. And so let me pause this here real quick. All right, finishing up naked Forex here. And so you have to understand that, when you tie in price action and candlestick structure with the naked Forex and following the trend structure with that, candlestick structure creates that trend structure. And then, with those 2 candlesticks and trend, then you're looking at the next highest price on the uptrend, or you're looking at the next lowest price to break on the support for the downtrend. And so that's the most basic way I can put it down. And you're not looking at what's being overbought and oversold, because it's not letting you know if it's going to be overbought and oversold. But you have to look at those key levels of resistance and support. And like I said, looking at the 15-minute chart to start out with, you'll dive down and look at a precise picture of, okay, candlestick structures are either ranging in a price or shooting up on the uptrend on the 15-minute. If not, then shooting down. And then you're basically hopping into the higher time frame, which I recommend would be the 1 hour or the 4 hour if you want to look at a longer time. Just go from the 15-minute to the 1 hour, and then you'll get to see where things are going. And so that way you get to see a longer price structure and a longer trend view of where things are going to go in the uptrend or the downtrend. So very important. Don't get yourself caught. And let me see what else I want to hop into naked Forex. Yeah, I mean, this is pretty important because what I'm saying here is that, if price is stuck in very narrow or consolidating, then you will need to wait for a candle breakout. And by that is that you have to look for these breakouts. When prices are very, very narrow, you have to look for those breakouts. And you have to look at, okay, if prices, let's just say if USD is stuck at 110, and we're looking at, okay, where is it going to break through, right? Where is it going to break through? Is it going to break through higher? Is it going to break through lower? Is it going to just stay here for the next, couple hours, or we have to wait till the next session to see that breakout? Most of the time, you probably don't see a breakout until the next session. And that's just my experience of seeing things for breakouts. Usually when it consolidates for that first session, then when the new session kicks in, then then you get to see a massive breakout. And then that's letting you know that they're going to try and put it either the breakout to the upside going back up, or the breakout going down to the downside going down. And that's your time to get in. And so that's just another thing to look into here. Entries and exits. Let me stop this and start a new video.